Your Highness Sheikh Mohammed bin Rashid Al Maktoum, Vice President and Prime Minister of the United Arab Emirates and ruler of Dubai. Your Excellency Abdullah bin Tuk, Minister of Economy of the UAE. Your Excellency Dr. Thani bin Ahmed Al Zayudi, Minister of State for Foreign Trade of the UAE. Your Excellency Dr. Ahmad Belhoul Al Falasi, Minister of State for Entrepreneurship and Small and Medium Enterprises. Small and medium enterprises here at the conference today. These are the backbone of our economies to whom this keynote address is dedicated. Fellow panelists and session chair, Excellencies, distinguished guests, members of the media, ladies and gentlemen, good afternoon. First and foremost, I would like to extend my appreciation to the organizers of this 9th edition of the annual investment meeting for this invitation to speak about improving access to capital for SMEs with financial risk management. At the outset of this discussion, it is in order that we acknowledge that we have come a long way since the turn of the millennium in understanding the value of MSMEs in our economies. We know that MSMEs account for somewhere between 50 and 80% of jobs in a given country. Importantly, we also know that they are also the biggest contributors to new employment. We also know how significant they are in contributing to total economic output, being responsible for somewhere between 40 and 70% of our GDPs. Indeed, in some countries, over 90% of all businesses can be classified as MSMEs, and many are key in driving competition and innovation in several sectors, especially the technology sectors. But of course, it is also the sad reality that less than half of MSMEs make it beyond their first 2 years of life. There is no doubt that MSMEs face considerable constraints and challenges. This is especially so in the developing world and frontier markets. Proportionately, MSMEs face higher compliance costs as compared to their larger counterparts due to the fixed cost nature of administrative processes. It is also generally more difficult for them to navigate the webs of red tape of our bureaucracies due to their capacity and lower bargaining power. They also lack economies of scale, which limits their ability to invest in fixed capital, people, and technology. They do face many constraints, but survey after survey confirms that it is access to finance, both in the form of debt and risk capital, which hinders MSMEs from their potential and often also their survival. The financing gap for formal SMEs in emerging markets is estimated at about $1.2 trillion and up to $2.6 trillion if we include the informal sector as well. In the case of sub-Saharan Africa, where we are from as TDB, this figure is estimated at around $331 billion, of which $42 billion is for women entrepreneurs. The numbers do vary from country to country, but they tell a similar story. It was hard enough before COVID-19, now it is even harder, with contracted demand for many services and goods as we know, and investment flows having frozen and supply chains deeply disrupted. Countless MSMEs have had to close their doors and people have lost their jobs, not just in the more vulnerable economies, but also in the developed economies across the world. Usually, to deal with liquidity challenges, the stronger SMEs typically access short-term loans and working capital. But this environment of heightened risk, the behavior of financial institutions has also been impacted by the pandemic-induced economic crisis. And this has resulted in many FIs holding back and bracing for adverse impacts. No doubt, banks are well aware of the domino effects that set in during such a global systemic crisis. Almost all businesses face disruptions and delays, yet they also have to cover operating costs. Cash flows have deteriorated and there have been surges in distressed assets. Sadly, while most financial institutions have continued to serve their big existing clients, they have often cut back on SMEs, given that they are less capitalized with less capacity to cope and survive. Even FIs that have strong levels of liquidity have had to consider new levels of prudential restraints. So what happens when liquidity dries up all around? And how can SMEs secure liquidity when their financial positions are even weaker than pre-COVID-19? And how can banking and non-banking financial institutions step in to meet MSMEs' need for capital while ensuring their own business continuity and at the same time managing risks smartly? Different financial institutions have different strategies and approaches. Many will easily cater to the needs of the tech-savvy MSMEs, which are well positioned to ride the digitization wave and, of course, enjoy the tailwinds in the process. Some, like TDB, have stepped up risk-sharing and co-financing partnerships with financial institutions who work alongside us to help shore up liquidity in various SME segments, while also looking to curtail risks. That's something we've accelerated since the onset of the pandemic through a special purpose program and continued on lending. While we have always worked with an array of international and national banks and development finance institutions, we have recently boosted and formed new funding partnerships with significant policy banks such as the African Development Bank, a key shareholder of TDB, but also the Arab Bank for Economic Development in Africa, the OPEC Fund, and of course the national development finance institutions of countries like France in the case of AFD, China in the case of China Exim Bank, KfW in the case of Germany, and of course others in Italy and Austria, among others. These new and expanded partnerships have endowed TDB with an additional $2 billion in long-term financing since the onset of the pandemic. A groundbreaking new partnership of note was with the World Bank Group, with which we have two new facilities. One is a $415 million long-term project financing facility with the World Bank's International Development Association, IDA, a facility that will be dedicated to SMEs operating in the renewable energy sector who are grappling with the challenges of the pandemic. This will be the first time the World Bank has extended such a facility to a regional development bank like ours. Also, a first of its kind is a 10-year guarantee of a euro 359 million facility issued by MIGA, which is the World Bank's multilateral investment guarantee agency. This was for a loan provided to TDB by a group of commercial banks across the world, and this is of course funding geared to supporting trade finance in our regional market in the face of the pandemic. Over and above funding, as many of us know, an important way of supporting MSMEs facing liquidity and other risks is guarantees and similar insurance instruments that help boost or maintain the appetite of various players serving this particular segment of clientele. For instance, we have an SME program at TDB that targets MSMEs, particularly those led by youth and women. We work with financial institutions that cater to the full spectrum of MSMEs, not only the micro enterprises, but also the missing middle SMEs, those that are known to be too large to access micro funds, but also those that are known to be too small or too risky for commercial bank financing to be availed. This is a program that is designed also to be scaled up over time with the funding of like-minded financial and development partners. The program also has a technical assistance component intended to build capacity alongside the sharing of risk and the provision of funding, something that is referred to often as a blending approach. Blended finance in this and other ways has been popular in recent years as a strategy of improving both access and cost of financing for SMEs. And of course, it is a strategy for reducing and sharing risk. It can be done in various ways by blending commercial debt with equity, for instance, or concessional capital, by availing project preparation funds, by providing guarantees or insurance, or as previously mentioned, by combining debt with technical assistance grant facilities. We at TDB have applied blending in our own capital structure at an institutional level by creating more suitable instruments for risk capital participation in our structures on our balance sheet by institutional investors such as pension funds, insurance companies, and sovereign wealth funds. These being typically institutions with very large volumes of funds that need to be deployed, of course, in a risk-managed manner. We have created new classes and segments of share capital for such investors, in addition to the government capital that typically underpins specialized multilateral financial institutions such as ourselves. We all know there's a lot of reference in recent years to the vast volumes of institutional capital across the world looking for a home, reported as being around $100 trillion, much of which is sitting idle in negative interest-bearing accounts or very low interest accounts. On our part at TDB, we have created new instruments to provide an attractive yield to institutional investors on a risk-adjusted basis. And we've managed to attract a diverse group of institutional investors, both from within Africa, but also Europe and Asia. In the context of the pandemic, and more generally frontier markets, investors need confidence to put their capital at risk for impact, but they need financial returns as well. So we have done our part at TDB by creating a special channel and platform for trade finance and impact funding to flow into well-appraised enterprises, projects, and trade transactions. Risk perception, we know, is often higher than reality. And of course, insurers know this and they tend to profit from this. This is why the likes of the Lloyd's of London syndicates step into facilities such as those at multilateral banks and TDB, into the various structures to provide risk mitigation products that turn out to be profitable in most cases. It also is why many institutional investors have been investing in our facilities, bonds, and shares that have various mitigations embedded in them. And of course, we use all the capital and risk mitigation collectively to co-finance and underwrite some of the risks of MSMEs, even in pandemic times. There is no doubt that investment-grade, specialized financial institutions like TDB in regions such as Sub-Saharan Africa have a very important role to play to enable profitable investment and trade. An interesting idea which has recently been circulated by a group of African DFIs is the creation of a COVID first loss fund, which could lower interest rates applied to corporates and MSMEs while maintaining healthy return on asset levels. Africa and its partners should continue to create relevant instruments to unlock suitable and longer-term financing for MSMEs, as these are truly the drivers of economic growth and long-term sustainability. And this lies at the heart of the 2030 Sustainable Development Goals. As I stop here, let me reiterate what an honor it has been to contribute to this exciting discussion about SME financing and risk management. It is no doubt a topic that deserves a high level of attention for the very many reasons we are aware. I thank you, Your Highness and Excellencies, for this kind invitation, and I thank you all for the time and for the listening.